Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I'm delighted again to be able to speak to Judith MacKenzie of Downing Asset Management, one of the UK's finest small and micro-cap investors. So welcome, Judith.
Good to see you again.
Yeah, well, when we last spoke mid-December, you were actually quite cautious on equities, but bullish on the more value-focused Downing portfolio, and that's been a pretty good call. The returns have been sort of like, you know, almost double what the what AIM have been, and certainly almost triple actually what the FTSE's been. So well done there. But we've had a bit of a sort of like a sort of investor sentiment has shifted really in the last couple of weeks in terms of growth fears not being quite as strong as previous expectations, and US 10-year Treasury yields have dropped below 1.4%. What's your view now on sort of small and micro caps?
We've got to be always bottom up, and you obviously look at the headwinds like inflation and supply chain issues and everything else. But you know, the best barometer for us is actually what our little companies are doing. And because we've been invested in some of these companies for a couple of years now and making sure that the catalysts are in place, we're actually more bullish about our portfolio in the investment trust than we have ever been. And you know, there are a few little things that are going on in the background, and that includes quite a lot of corporate activity. If you look at the M&A activity over the last quarter, is higher than it was pre-COVID. And I think, you know, and that's been with investors coming into the UK, not M&A activity within the UK necessarily. So basically what companies are telling you and what corporates telling you is that our smaller companies are cheap by world standards. So, you know, that's all I need to know. We're still investing, we've got a great portfolio, and we've got the catalyst to drive it within the portfolio. So I'm probably a bit more bullish than I was back in December, despite the headwinds that have come across us.
Just on the that M&A theme, Judith, there's been quite a bit of sort of like acquisitions from overseas buyers. You've had Philip Morris buying Vectura, and you've also had Amino Diagnostics Systems being bought by a trade buyer. And I did notice you've got some sort of like super durable growth stocks, similar sort of deal. They've got Alliance Pharma and Venture Life within those particular portfolios. One is, I think there's Alliance Pharma is about £500 million, and you've got Venture Life just over 100 million. But they do sort of like OTC medicines and prescriptions, etc. And they're a bit of a buy and build strategy. And they've both actually been on the acquisition trail just recently. Could you just talk us through those two sort of opportunities?
Yeah, it feels a bit wrong to bump them together, but you're right. There's quite a few similarities between these two companies. And what we like about Alliance Pharma is, you know, it's a big brother to Venture Life, and it's really nice and steady. It's been acquisitive, but it's also got really, really good distribution and earnings growth. But you know, Venture Life's probably for us a little bit more exciting. They've been acquiring, as you say, and they also prove that they're very good at the organic growth side of things. So the businesses that they've actually acquired have grown by 30%, which is nice. So it proves that they can actually buy. But then you've got this real kicker from the operational gearing that they've got. So I think last year they grew their revenues by about 49–50%.
Yeah.
But that actually resulted in nearly a 200% increase in operating profit. So that's really nice. And then you get some of the synergies that are also coming through through these deals. But they're just good at doing what they do, really. It's a management team that have been there and done it before. And we did get a little bit concerned that it was taking quite a lot of time because they raised money in, I think, October, November last year. And they only just did the deal with BBI in the last sort of 8 weeks or so. So we were a wee bit concerned the cash is going to be burning a hole in their pocket. But now actually they've got BBI in bed, and they've also got another 50 million worth of firepower. So they've got the operational gearing, and you've got that debt financing opportunity coming through as well with further acquisitions. So yeah, it's a good one to watch.
Yeah, and I'm guessing what the sort of the trick here is you buy at a price which is, or you raise capital at below your sort of like your current trading multiple, and then you put that to use within, you know, basically for M&A at a similar or lower multiple, and then drive the value through a bigger scale by for the synergy sales and cost synergies. And then hopefully once you get a bigger scale, you'll just drive hopefully a market, you know, more closer to a market multiple of sort of like high teens, 20%, sorry, 20 times EBIT.
That's it. That's it. And so here, if you look at the headlines, Venture at Life bought BBI for about 13.8 times. But then you take into account the synergies, it's closer to 9 times. And then you look at what Alliance is doing. So they tend to pay 7 to 10 times for pretty steady state businesses. But the latest deal that they did was on 16 times. So exactly what you're saying, that's how it's going to play out, we hope.
Yeah, good. And then you've got some sort of like quite interesting, got plenty of sort of quite interesting sort of like recovery, infrastructure and housing plays. There's you've got sort of like James Latham, Inland Homes, and Flowtech as well, which are all sort of like still relatively cheap, actually. You know, in terms of, well, certainly Inland Homes and Flowtech. Do you want to take Flowtech first of all, because they've got a really sort of lot of self-help, and the shares have increased, but I think they're still trading at about 11 times, 12 times PE.
Yeah. I mean, it's again, you know, bunching these together. I understand what you're saying from a sort of infrastructure perspective, but you know, these are sectors that we don't tend to play. The Inland and good old Latham have been in the portfolio, IC portfolios, for probably about 8 or 9 years. So you know, we like sectors, but so what we're trying to do with those two is just buy the best quality that we can find in those sectors, and then leave them to it. And I would probably bet that those companies are probably going to be in the portfolio for the next 8 to 10 years as well, unless they do something different. Flow is slightly different because, yes, it is a play on the overall sort of infrastructure side of things and the growth that's coming through there. But as you say, there's a bit of self-help. There's probably about 5 million worth of cost savings that they're now pushing through. It's not been a turnaround, but certainly there's been quite a lot of change going on there. And it's with a chairman who's been there and done it.
Roger McDowell.
Yeah, that's the man.
Yeah.
And he's good at buying stock as well. We quite like when management teams put their hands in their pockets. He's been really good at doing that. And of course, you've got, you know, some good bedfellows with Mr. Mills also being a big shareholder there, and also Gresham. So we know that it's not going to be sitting back doing nothing, put it that way.
It's a distributor basically of sort of like niche pneumatic and sort of fluid parts, isn't it? That it's sort of like then serves, if somebody's got a sort of like an urgent need, then it supplies that sort of like quite niche-y part. And I guess the trick is to balance demand with the working capital requirements. And if you can squeeze the working capital, but and in fact actually increase customer service and product availability and get that whole efficiency cycle, perhaps through own digitization, you then get a kicker of more cash being generated, plus you get higher margins. And I think it seems as though Roger McDowell has had plenty of experience in this. And also, I think I can't remember the guys, the CEO, Bryce somebody, isn't it? And Russell, is it? Bryce and Russell, is it? And they seem to be really on the same page to drive that business to effectively improve capital returns, but improve margins as well.
Yeah. And it's, you know, it's not going to happen overnight, but it's one that, as I say, you know, with a shareholder list like it is, and quite a clear, defined strategy that they've articulated to the market, then you know, it's going to play out. Definitely.
Yeah, and James Latham is a timber merchant, isn't it? Distributor, family owned, which is, I mean, they've just been knocking the ball out the park for the last 10, 15 years, and they've been very much under the radar screen. But it seems to be, I mean, obviously timber has just gone through I don't want to say it as a pod, it's gone through the roof, hasn't it, in prices, but it's actually coming down a bit. But they seem to be, their biggest problem seems to be not demand, and it seems to be a bit of supply, because some of their own suppliers seem to be struggling to give them sufficient quantity.
That's right. I mean, that's been a feature across that industry for a while. You're right, it's a really boring company, and that's why we love it. It's undercovered really by the sell side. It's family owned, it's got quite a low free float. So there's a lot that maybe people would turn away from. But, you know, it's got property value hidden in the balance sheet. They're not a promotional management team by any means, but it's a really good quality, highly cash generative business. And what we like about it is that, you know, they just tweak away at the edges. It's not going to shoot the lights out, but they're really, really good at just running the business efficiently. And they just round out market share gains and really just operate properly in that sector. And as you say, the feature of the sector at the moment is that there's quite a lot of demand. So, you know, it's been in the portfolio for a while, as I said, and it's probably most likely to be in the portfolio until the management team decide to sell it.
Yeah, I'd point investors, I would just say, you know, you need a few rocks in your portfolio that will be there as granite, be through thick and thin, and you can rely on. I mean, you can sort of like try your hand at a few others, more risky bets, but if you've got that sort of like that whole big anchor there, then you get, it allows you to sleep at night, doesn't it? Because you know these, if they've survived a century, they're going to survive the next century through thick and thin.
Yeah, they should do.
Yeah, oh, and one with inland homes, the sort of like, this just seems to be the cheapest house builder, sort of like, what isn't it, house developer around. And I do wonder that it's always been cheap. I know Simon Thompson Investors Chronicle likes it as well. And they sort of like do developing brownfield sites in the southeast of England. They get they're one of the unique, actually. They buy, as I understand it, land pre-planning, so it's pre-planning consent, and then try and push it through. The difficulty you get is that you then suck up a lot of capital in that investment, and then have to batter your way through the planning process. And as I say, they're trading at about 25% discount to net assets. And given the sector's trading at 1.5 times, is that a justified discount, or is that sort of like there's good upside here still?
Yeah, I mean, it's a good point, because if you look historically, they've kind of always traded at a bit of a discount.
Yeah, they have. Yeah.
And you do wonder what that breakout is going to be. But again, you know, it's a pretty steady management team that own quite a bit of the business themselves. And what they're really good is at working through that. And maybe what the market doesn't like is the length of time that it takes to work through that planning. Yeah. And that could be the turnoff. And then, as you say, you end up with a bit of kind of working cap cyclicality as well. But, you know, for us, you know, holding it for 5-10 years, that's okay, because it plays out at the end. And actually, you know, you get the cash generation that does come through. And also you're holding a nice, another relatively boring, dare I say it, asset that you know, at some stage will probably get valued properly by the market, but in the meantime is going to give you some reasonable returns. So it's sitting at a discount to the rest of the peers.
No. I mean, I would say, I'm with you. I would say, you know, what is going to be the catalyst? Well, frankly, somebody's going to buy them because they're going to take, if they've bought, I think it's Stephen, is it Stephen Wicks from Remember or something? Yeah. Exactly. If he's, I mean, presumably he's bought sensibly, because I think he had the old Tesco site, if I remember looking at it, sort of Cheshunt or something like that I've seen. But, you know, you've got sort of prime site assets like that. And if you've got sort of bought well with land looking for planning permission, and presumably you've got Boris saying, you know, you're going to basically develop and create more houses, 300,000 houses, then, you know, at some point in time, somebody's going to knock on their door and just say, look, we'll take this business at, say, I don't know, 25% premium to assets, because that's where house prices are sort of like headed. So that's good. That's good. And then you've got some really quite sort of like good post-COVID winners. You know, sort of like the whole digitization process and stuff like that. And do you want to start off with sort of Tracsis, which is the digitization, the software and services digitization of the whole of the UK sort of rail system, improving that whole service, isn't it? I know it's been through a sort of checkered history, but actually the shares are still reasonably, you know, sort of like, you know, got potentially upside if they can monetize their IPR.
Yeah, I mean, we've held this one for 12 years.
So, okay. So not short. You got the history.
Nah, we're not short-term shareholders here. So I mean, it's changed its spots quite a lot since we first invested in it. I think it had about 800 grand worth of EBITDA at that stage. It's not cheap. I don't think it's cheap. But what is really nice about it is, in that, again, it's a kind of a wee bit of an infrastructure play. And when they're selling software at great margins, 80% margins, into the train operating companies, so they're selling it in for the lifetime of the Talks franchise. So you know, that's a 7 to 10 year franchise. Now, it's a contract that's probably between 3 and 5 years, but it's recurring revenue for the. You know, they're not going to change their rail timetabling software halfway through a franchise. So, and then you've got all this chaos that's happening in the rail market with basically changes to, well, and quite rightly, investment in that infrastructure. But they're not just a play on rail, they're also right across the whole transport, highways, maintenance sector as well. And the one thing that I think they'll probably benefit from post-COVID or mid-COVID is that when we all start getting back out and doing things again, they've got a little events management business that basically, if you're going to Glastonbury or whatever, and the chaps are standing there directing the traffic and making sure you're parking in the right place. So they manage that, and again, got software and IP behind that. So it's a cracking little business. It's, as I say, it's not cheap, but it's quality.
Yeah, I mean, I would certainly say again, you could find a foreign buyer deciding to lift and shift that technology onto a more global footprint, because you'd automatically on day 2 of buying that be able to generate potentially huge synergies, because you could sell that pretty much proprietary technology outside of the UK. And yes, the UK may be a big captured market with rail track and whatever it is, but frankly, there's bigger rail networks abroad, aren't there, where you know, you do, particularly if they wanted to get some sort of like help. And then I mean, that was, the Tracsis is roughly around about market cap of 275 million. But you've got really quite a couple of small digitizations. You've got the B2B sort of like internet real estate stock Digitalbox, and then let's start with that, because I know we touched base last time, and the shares haven't really moved since then, but it's sort of continued to make sort of good progress in terms of monetizing its internet real estate.
Yeah, I think, you know, it's one to watch. So a new chairman went in, I don't know, 2-3 months ago. There've been a couple of little board changes, and they've talked about their buy and build strategy. So you know, it's one to watch this space on, because you know, they've got a couple of decent titles, 3 decent titles at the moment, in quite niche verticals. But really, the game plan here is to add to those titles and really monetize the platform that they've got. So you know, it's not just about having Entertainment Daily and you know the tab,
and they've got the tab and the mash, haven't they?
Yeah. The tab, you know, obviously in the student market. So these are quite niche. They'll grow in their own right, but the skill here will be in the buy and build. So watch the space on that one. It won't be small forever.
Yeah, and then another one is Universe, I believe, which is basically the digitization of sort of like convenience stores, but petrol forecourts in the UK, and they sell software, services, and hardware, etc. And I did notice they've had a management shift just recently, and the chairman bought about 8% or 7% of the shares off effectively, and you know, a guy who I think it was the Celtech acquisition, the founder, who then wanted to sell the shares to somebody, and the chairman picked it up, which is always a good sign. I mean, that one must have been a significant purchase. So he's obviously very confident at current levels that the business is going to do well. Market cap's roughly around about 14 million. And I know Gresham House are in there as well. So it's got presumably a sort of like a decent outlook here.
Yeah, it's so that again, you talked about this sort of move to digitization, and they have in the past been a bit of a box shifter. Yeah, and they do the refreshes for like some Morrisons and
it's execs on it. SO, isn't it? SO.
Yeah. But that's not really what the catalyst is here. The catalyst is also the move to outdoor payment systems. So when you go to the field forecourt, especially COVID, you know, you don't want to go in, and you can pay outside, and they've got probably most of the real estate on the OPTs in the UK. So and then being able to sell more of a solution as opposed to just shifting a box for Morrison is the real key here. So we can see that you can get the operational gearing, but you can also probably get close to a doubling of margin. So that's quite an attractive play. And one common thing in all these companies that you just talked about, Tracsis, Universe, Digitalbox, they've all been through a degree of sort of management change, and it's because actually some of these technologies have been around for a long time. Universe's H-Tech is the technology. I think we first invested in it again about 10, 12 years ago. But they're coming to a kind of a crossroads where they're taking that technology and they're moving it to the next stage. And that's the management team, the changes that are going through these businesses are really signifying that is quite a catalyst, I think, to watch out for in the next 6 to 12 months.
Yeah, and I think also that the whole big picture in terms of the digitization of corporates, they've had to, during the pandemic, put in software and cloudify all their front communication systems, so Teams and Zoom, etc. And now the next priority is to do their sort of like their next heavy lifting is what their major operations are, whether it's front office, back office, blah blah blah, and clearly sort of like the whole retail side and sort of the digitization of forecourts is right up there now. So you're right, the timing should be perfect. You'd think the next 6 to 12 months should be pretty good. Now again, moving on to which I'd never even thought about, Lok'n'store is a self-storage business in the UK, and it's gone gangbuster because of the COVID, because I think they've had a lot of online customers who need self-storage to help them sort of like deliver parcels. And obviously, likewise, there's been a huge activity in the housing market. So their occupancy rates have gone from about high 60s to that's an 80%, which is just like absolutely incredible.
Yeah, it's happened across the industry. We're obviously all tidying out our houses and then not wanting to throw stuff away. So yeah, it's a bit bizarre. I mean, I think for us, this one's just a pure net asset play more than anything else. Really good operators, great dynamics in the sector, and it's sitting at a really decent discount to its net asset value. So yeah, what's not to like in that one? It's another one that we invest in for our IHT portfolios, and in these types of portfolios, you're really just looking for things that are pretty steady, pretty boring, but just keep rounding out the earnings.
Yeah, well, if there's a long-term trend of people deciding, I mean, I guess the other thing which is driving that type of business is that because there's been a big dislocation in the employment market, but especially last year, people with a bit of entrepreneurial spirit have decided to leave their jobs and set up shop on their own, but gone to an online format, and therefore may not even have a garage if they're in London, but they need a lockup to be able to hold a bit like your Del Boy type of stuff. But rather than actually use it in your yellow van that you go around with Trotters Traders on, you're delivering basically through the internet, and to do that successfully, you need some space. So you just say Lok'n'store. I think there's a couple of others, isn't there, which are also in that space. But that could be a long-term theme if more and more people decide to actually do the business online. Yeah, well, another one is a real sort of steady Eddie, which has got a chance, especially to increase margins, is Sureserve, which I understand is sort of the theme on there is that they do all the servicing for sort of like affordable housing and social housing and stuff like that. But for the whole sort of domestic energy efficiency, the upscaling of that, and also presumably the home digitization with things like smart home technology to be able to improve all that sort of stuff. So they seem to be well positioned. The problem they have, I guess, is improving the margins.
Yeah, I mean, it's a bit of a contractor, I think is probably the best way of putting it. So that's the negative on it, and it's been through a bit of a turnaround as well. And it's just, again, it's got a new management team too, a new chief exec's just gone in. So there's been quite a lot of change, and in fact, I think Christopher Mills is also on the board there. So another common theme. So I think you talk about that whole kind of connected home element, and there's one of the reasons that we got involved in this business was that we were doing a lot of work with Fire Angel, another portfolio company, and they sell smoke alarms and CO alarms, and that whole connected home and local housing authority moves to make sure that that health and safety, ex-Grenfell, health and safety is actually at the forefront, and it's actually the likes of Sureserve that do the deployment for those kinds of solutions. So it was a bit of, I suppose I was thinking about it from a holistic point of view and saying, okay, there's got to be more attention, both in terms of boiler maintenance and health and safety, and really who's going to be able to deploy it. And Sureserve have got one of the best networks. They're men in white bands, but they're also there's a lot of IP behind it as well.
Yeah, I think that's the key, is to sort of like go further up value, and then you become less of a contractor, you become more of a service provider, don't you? And therefore it will justify. But the hard bit is actually to get on these purchaser lists of a lot of the affordable housing markets. Once they have, and they have got the reputation, then it's a matter of, if they can, I mean, with Christopher Mills or, behind them and yourself behind them, if they can buy sensibly some further unique technology to be able to lift and shift onto their footprint, then that will be absolutely a game changer, I guess. And they'll be able to be more of a price setter rather than actually a sort of like a price taker, I guess.
That's it. That's the game plan. Yep.
Yeah, and then the one that's just changed sort of names, actually. It used to be, I used to know it as a IP tele type of business. Like Amino Tech is now Aferian, I think it's called itself. But they're going to change their chairman. I think Karen Batch is sort of decided to step down, and I think the big trick here is to sort of move. They've given them some ambitious targets, but to move more into software and services over the next sort of 5 years and improve that margin and also the recurring revenue streams, I guess.
That's it. That's another one that's gone through a bit of a management change, as we talked about as well.
Yeah.
And there really is a theme here, because Amino and some of Tracsis, these businesses we've owned for sometimes 10, 12 years. Amino we sold probably about two and a bit years ago, because it was still, dare I say it again, a bit of a box shifter, and we didn't quite believe that they could migrate into being more of a software play. But actually, if you look at that shift in revenues over the last 2 years, it's only in the last sort of the last set of reporting accounts that you could see that margin benefit was coming through. And so therefore we got back into it around about a couple of months ago, 2 or 3 months ago. And if you think about it, most people they're not consuming TV on a TV, they're doing it on multiple devices. And actually it's the software that's here, not the hardware necessarily, the software that's here that enables that. So it's not just selling into the hardware solution, but you've also got networks, the box shifters themselves buying it, and you're having multiple devices. So you want to be able to consume on your iPhone, your iPad, and your TV, and have the same kind of experience. So I think Aferian, as it's now called, always get a bit worried when companies change their names.
Yeah.
But Aferian, Amino, as I know it, it's going to again be a slightly different company in 2 years' time than it is at the moment. And that margin shift has got massive operational benefit in the earnings. So if it plays out the way we think it will, then it could be worth watching.
Yeah, and also I'm guessing just the whole market about sort of like, your traditional sort of content providers, they want a direct to consumer model. And if they've got sort of like a straight, they've got good content, but only a website, and they want to get it over the top telly or whatever like that, then they've got to go to somewhere. And you're going to get more and more of that fragmentation of the whole media sector. And these people actually do need a vehicle, some sort of like software to be able to do that. So it should play well into that whole theme, I would have thought.
Yeah, I think so. There's some bigger players there as well.
Yeah.
But they're not going for the big ticket tier ones. They play in the tier 2 and tier 3.
Yes, exactly.
So that, they can pick up quite a bit of a good number of clients within that base, I think.
Yeah. And then in one sector I've never even sort of looked at is the whole sort of opportunities in agriculture. You've got sort of like two areas of almost like two sides of the value spectrum. You've got Anpario that does sort of like ingredients for animal feed, but it's all natural and it's sort of like engineered and designed and all the patterns. And then you've got sort of an agricultural food and fertilizer distributor, Wynnstay, which is is another rock solid type of James Latham stock, I guess. But I've never really looked at agriculture. Just top level, what sort of interests you on the agriculture? I mean, it's obviously something that we all need, and we need to improve the quality of the food chain because we've had so many problems. I mean, just look at COVID, where it supposedly came out of a wet market in China.
Yeah, well, I mean, that's it. It's a bit like housing, is it? So we all know that we need more housing, and we all eat. So therefore, it's not going to be something that changes too much. So we're really just looking at what we think are the best quality players in that sector. And again, they're very, very different. And Anpario isn't cheap, I have to say.
Yeah.
It's really good at what it does, and it's quite unique. And it's probably one of the companies in our portfolio where we've got the best kind of global exposure, because they sell literally worldwide. And if you think about the changes in eating habits in the likes of China, they've not been used to responsible farming. So therefore, anything that drives out antibiotics and steroids within a food chain is pretty good. It's a good thing. And also, this little company helps improve the yield without those types of things. So, and there are not that many other players in that sort of high-end sector. Wynnstay is quite different. It's a bit like a family-owned business. More than anything else, it is more driven by commodity fluctuations. So you have to be aware of that as an investor. But actually, it's a bit like James Latham. If you look at the balance sheet, it's really, really well supported by net assets. and you've also got some really quite decent earnings growth that can come through as well. And of course, everybody's been out buying dogs and cats and goodness knows what else.
Of course, yeah,
so,
of course.
You know, it's not a play. It's not a you know, you're not running out and buying pets at home or some of the bigger players, but they also benefit from that little dynamic.
Yeah, and then sort of like going forward, what sectors are you sort of like just top level you're sort of looking at? Is it really the sort of I mean, you obviously mentioned it's sort of bottom up type of investing, but just big picture, you've got quite a bit of cash still on your balance sheet to be able to deploy. And I was just sort of like wondering the sort of the areas and the sort of the sweet spots where you're looking.
Yeah, I mean, the cash on in the investment trust come about not because we've been strategic and thinking about trying to build cash at this point in time. It's been the beneficiary of an exit to another PLC in one of our portfolio companies. So we had about 5.6 million come back into the portfolio in the last
was that
month.
Real Food Group, was it? You got paid off your debt, wasn't it? You had a good payday then.
That was a nice payday. Yeah, we got a nice redemption premium, our interest and everything else back. So yeah, you know, there's that catalyst playing out. We sold Brighter Foods to the Hut Group, which was nice. Yeah. So that was part of that catalyst playing through. But so we're also we've got. I'm not going to tell you actually.
No, don't, please don't. No, you tell me next time.
I'll tell you next time. Yeah, we've got a nice whip list, and obviously, you know, we're very much bottom up. We are trying to think more about these kind of themes that we talked about today. But ultimately, we're looking for businesses that we can find catalysts in, and then hopefully we can be a little bit instrumental in being able to help drive them alongside other shareholders. So it's more about that than anything else. But you know, we have been mindful that we like a widget manufacturer. You know, you find a widget manufacturer in the Northeast, and you know, we're all over it. So we're trying to maybe diversify a little bit more away from that, and think about some of these digitization themes that we've talked about today as well. So, you know, really looking for next generation IP that can be applied to these kind of markets that are clearly going to be growth markets for the longer term. But we're not just jumping on a healthcare or a growth momentum. It really is making sure that, you know, a lot of the power and the earnings is in our hands, where we can touch and feel where it's going to come from.
Yeah, I would agree. I mean, that's two areas that I'm looking at. You know, it's sort of like, you know, where is the puck heading? And it's all in that whole, you know, you've got secular growth in technology, software, the whole digitization of back office, etc. So technology is already heavy in my portfolio, but I'm looking more. And then I'd say just on the healthcare and medicine side, we're entering a golden era of medical research and application, and the market and that is just exploded and will continue to grow very, very rapidly. So yeah, I'm looking forward. You've whet my appetite there, Judith, to next time you can tell me where you're sort of like you're putting your chips. But in fact, we might be putting our chips in the same place. You never know, because both sort of have a value tilt.
Yeah, very much so. Yeah, we'll be able to tell you more next time.
Okay, brilliant. Well, thanks very much for your time, and really appreciate the great insights again, Judith, and best of luck, and look forward to touch your base again.
Great. See you soon.
See ya, bye.